Hi there. Thank you for coming back again. I had a great question regarding one of my videos about why an interest rate can go from 5% to 9% in one adjustment period, and that's a great question. I guess I took it for granted that everybody was familiar with an adjustable rate mortgage, so let me explain it a little bit more in detail, so hopefully it'll clarify some points for everybody. Typically when somebody buys a house, the only way that they can afford to get in a house that they want is by taking a lower rate interest loan or buying less of a house. So if somebody can qualify, for example, for a house for $200,000 at a fixed interest rate of, let's say, 6% or 6.5%, if the interest rate is lower, they can qualify for a higher loan because the interest rates are lower, so the payments are lower. And when you're qualified for a mortgage, you're qualified based on what you're going to pay today on the mortgage, not in 2 years from today. So what happens is when somebody takes a variable rate loan out, typically what they have is what's called a teaser rate. A teaser rate is an introductory rate, and it might be good for 1 or 2 years. It could be good for as long as 5 years. But most people don't take it because on a 5-year basis because the interest rate will be higher. So the lowest rate you can get is typically a 2-year fixed. So your interest rate might be 5% for 2 years. But every year after that second year, you're going to have an adjustment period. And once that adjustment period kicks in, the interest rate skyrockets. When you take out a variable rate loan, you have two things that affect the loan, two factors. It's called a margin and an index. The margin is fixed for the life of the loan. So a margin might be at, let's say, 2%. What the margin is something that's added to the index. An index is something that fluctuates. And typically on a mortgage loan, the index is tied to a treasury bill or a LIBOR. It's a cost of funds index, and that comes from England, that rate. It can also come from California. So those are the best ones to have and the least volatile. But most of the people, what they take, and my suspicion is they take it because the introductory rate might be lower, but I also have a feeling, and it's not substantiated, but I think a mortgage broker might make greater commissions on the other loan, which is tied to a T-bill. So if the index is, let's say, 5 or 6% at the time of an adjustment period, it could be as high as 7% or even higher. So if the rate of the index is 6 or 7%, you add the margin to that and you come up with your new interest rate. The problem with a variable rate loan is there is no cap. In other words, there is no maximum amount that the first adjustment can have. So you can go from 5% to 9%, and that's what's happening. So for 2 years you're safe. And most people don't have the foresight to look 2 years in advance. You know, most people, when they look at anything, they look at it on a very short-term basis. Whether it be purchasing a new car or buying that big screen TV on a credit card that they don't realize how much it's going to cost them once they start paying the interest on the credit card. People are very short-sighted. They want immediate gratification. And sometimes that's a little detrimental to their cause. So that's how it goes up. There's a margin and an index. They're tied to different factors. And that's what happens. You know, if somebody would have taken out a straight fixed mortgage, which is always the best, a fixed rate mortgage, they couldn't afford the house that they just bought today. Unless, like I said, unless somebody's gonna move in 2 years or 5 years, then it's a problem taking out most of these variable rate mortgages. So I hope I answered that question for you. I could go into it in greater detail. But if there are any other further questions, I'd be more than happy to answer them, and I'm sure that I can. So I hope everybody has a great day, and I hope that answered your question. Bye.